Namaste everyone, welcome back to the lecture 7 of Fundamental Analysis of Companies. In the previous lectures, we have covered profit and loss statement, we have covered the balance sheet, cash flows, and we have also covered financial ratio part 1 and part 2, where we have covered ratios like PB ratio, earning per share, PE ratio, PEG ratio. And in financial ratio part 2, we have covered your current ratio, quick ratio, debt to equity ratio, and your interest coverage ratio. In today's lecture, Financial Ratio Part 3, will be focusing on the profit ratios, ROCE, and your CAGR. So we'll be going through the ratios like gross profit ratio, operating profit ratio, net profit ratio. By the way, if you're unaware of these terms, we do have covered them in our lecture of income statement, so please feel free to watch it. And after covering today's lecture, in the future, we'll be proceeding to all of the remaining lectures which you have left. So let's proceed to our lecture. So the first ratio which we are going to talk today is your profit margin. Now, if you remember from the lecture 2, we have three kinds of profits. The first is your gross profit, the second is your operating profit, and the third is your net profit. Now, if you don't remember it, please check out that lecture again. So let's proceed to the first profit margin ratio, which is your gross profit margin. The gross profit margin is when you subtract your cost of goods sold from your revenue and divide it by the revenue. And by the way, you have to multiply it by 100 to make it a percentage, and that's what we generally account for when we call margin, like gross profit margin. So we account them in a percentage, so you can multiply this by 100. Now, what all comes into cost of goods sold? If you remember, these are the direct cost involved. Like suppose I'm making a product, so whatever is my cost of raw material, direct labor, those all comes into gross cost of goods sold. Okay. Now, why is this ratio important? So the physical significance is, say I make a product and there is a cost involved to make that product. I'm still not talking about the rents, the utility bills. Those will come into your operating expense. So the amount of margin which I have from the raw material to the final product, that is my gross profit margin. Now, when you get into a business, you should know that how much gross profit are you going to get, because the higher the gross profit, the better it is, because you will get some buffer to account for your operating margin and operating cost, and also your interest and taxes. So that's where it becomes important to know, if you are manufacturing a product, what is your gross profit. Okay. The second is your operating profit margin. Now, if you remember, operating profit is your gross profit subtracted by your operating cost. Now, what comes into your operating cost is your rent, okay, and you have utility bills, and you have marketing cost, and you have a lot of other costs, right? So these are your operating cost. These will be there because in order to sell that product, you have to do some operations over and top of manufacturing it. Okay. Now that shrinks your margin. That's why having initially a large gross profit margin will help you to better cover your net profit. Okay. So now the operating profit margin would be same, your gross profit minus your operating cost divided by your revenue into 100. Yeah. Now the third ratio, you still have to pay the interest for the money which you have borrowed and the taxes to the government. Now the net profit margin is your operating profit minus your interest and minus your taxes. And when you divide it by revenue and multiply it by 100, you get this net profit margin. By the way, you don't have to literally remember the formulas or do it, because the ratios will be readily available, but you still have to understand the physical significance. Like gross profit margin would help you to get the overall picture of how much the original margin you had. And then if your operating profit margin shrinks dramatically or drastically, you can get an idea that your operating costs are way higher. It shouldn't be this much higher, right? Because initially your profit was way high, and now by including the operating cost, it's shrinking a lot. So you have to optimize your operating cost. Okay. This was in terms of business. In terms of stocks, you can compare it with peers, and you can judge that this peer has a better operating profit margin. And while both of the peer industries are manufacturing, say, soda ash, so that means one of the companies doing better on its operating cost. So this is how we compare. So let's understand this better with the help of an example. So in this example, let's take Tata Chemicals and compare it with its peer industries. Again, Tata Chemicals is just an example. It's not at all a suggestion. We just need one stock to present it, right? So we have just taken Tata Chemicals. And if you compare the GPM quarterly percentage, so when I say quarterly, we were not able to find the annual gross profit margin in screener.in, but we found it somewhere else. We will share it in the next slide. So the gross profit margin for a present quarter for Tata Chemicals is around 63.83%, while for peers it is way less than that, right? And if you compare it with the industrial median, by the way, we are going to use median and not mean. You can watch lecture 5 and where we have explained why median is a better criteria to compare than your mean. Okay, so your median was around 36.9%, while your Tata Chemicals is doing around 63.83%. That means it has a better gross profit margin across the peers, and that is a good thing. Okay, the second is your operating profit margin, and your operating profit margin for Tata Chemicals is around 22.7%. While if you see for peers like Pidilite, it's around 17%. For Deepak Nitrite, it's around 16%. I mean, it's still doing better on the operating cost. That's what it tells you. Okay, now you might argue that the amount of products or the portfolio of the company of Tata Chemicals and Pidilite is exactly not same. So yes, that's true. But for an overall comparison, this method works pretty fine. And later we will be doing a peer industrial comparison where you can actually get to know whether the companies are manufacturing exact same products or they have different products. Okay. But this, I mean, you can't really just compare two exactly same companies, and finding two exactly same companies with the exactly same product portfolio is also difficult. But this method works fine for our analysis. Not fine, it works actually pretty good. The third is your net profit margin. Okay, so the net profit margin of overall industrial is around 8%, while Tata Chemicals is around 14%. If you see across peers, I mean, SRF has around same profit margin, while Gujarat Fluorocock has around 23%. And if you see, I mean, among peers, Tata Chemicals seems to have a good net profit margin as compared to its peers. So it's a good sign. So this is how you will compare two things. One with the industrial median, and the second is across the peers. How well is your profit margin? Okay. Now let's try to compare how are these margins over the years. So there are two things. One is to compare across your peers, and the second is how good are they improving it over the past few years. Okay, now don't worry, we will let you know from where we got this data, and you can find this for every company for free of cost. So we will be covering them in our hands-on session. So if you see for Tata Chemicals, I mean, the gross profit margin over the year have actually increased, right? From 2019 to 2023, it has increased from 21% to approximately 24%. Okay, that's a good sign that they are increasing their gross profit margin. Now there could be various reasons for it. Suppose they might have introduced a product which has a better gross profit margin, and because of that this has been risen. Okay, there could be multiple reasons. There could be reason that the cost of raw material have dropped down, or they themselves started to manufacture that raw material, so the cost has got down, and numerous other reasons. But the important thing to remember here is that if you look at an overall picture of the company, we are not going minutely into the detail that what was the exact reason, but overall as the picture, the gross profit margin has improved, which is a good sign. Okay, the second is your operating profit margin, which if you see from March 2019 to March 2023 has again increased, and it has actually dropped significantly in March 2021. There could be some reason for it, but if you see overall it has increased. So that means somewhere they are optimizing their operating cost, which is a good sign. Okay, and your net profit margin again has increased from March 2019 to March 2023. What this would mean is your net profit margin consists of your interest and your taxes. Now that could basically mean that somewhere they are reducing their interests, somewhere they are borrowing less, so they are becoming more independent. Okay, and that is what is increasing their net profit margin. Again, this is a good sign. Now you might be wondering how to do a peer comparison and a comparison of companies' historical data, because what we have seen in screener.in is that we can only compare across the peers. I mean, you were not able to see from March 2019 to March 2023, right, in the previous lectures. So that's where we found another website. So we wanted to take you slowly over the websites, and let's actually go to the next slide and understand this better. So in the past, we were using our screener.in to actually find out the data that we need, okay, to analyze it. And this is good for doing peer comparison, but it was also good to analyze your income statement, your balance sheet, and your cash flow across the historical data. Okay, but if you wanted to talk about financial ratios, can I get historical financial ratios in this website? So the answer is we couldn't find it yet, but we have more websites, and I really don't wanted to introduce all the websites in the first class, which would make you nervous and confused. So now we are introducing second website, which is your money control. It is also one of the famous website, and this would be used to actually compare and do the historical performance of the company. Don't worry, you will get everything in a table similar to how you got in screener.in. So you really just have to run your eyes and analyze the increase or decrease or the reasons for increase and decrease. That's it. Okay. Now the second financial ratio for today's lecture would be your ROCE. ROCE means return on capital employed. Okay. So the formula would look something like this. ROCE is your operating profit divided by your capital employed. Now, operating profit we have learned multiple times and it's pretty clear by now. But what is your capital employed? The physical significance of capital employed means how much money am I putting it in the business. Okay, now how are you going to find the capital employed? It is your share capital. If you remember, you can also go to lecture 3 balance sheet to revise these terms. So you have your share capital, which is the initial money which the promoters put. Then you have your reserves and surplus, which are the money. It's kind of like the money which is left with you. And then you have your non-current liabilities. Non-current liabilities would be something like the long-term loan which you have taken. Okay, we don't include current liabilities in the capital employed. The reason being you have to give those money back in the current financial year. Okay, although you can call them as say current capital employed, or there could be various terms where you can even account for them also, because somewhere or other when you talk about current liabilities, you took that money to put it in the business, right? So that has to be accounted. But for like an overall general term for capital employed, we don't account for current liabilities. You can also say that capital employed is your total assets minus your current liabilities. That could also be your formula. Okay, so the physical significance of ROCE is that the amount of money that I put in. Suppose I have 10 crore rupees and I have four businesses. Businesses one is for automobiles, business two is to set up a laundry business, business three is say to set up a waffle business, and business four is say suppose a car washing business. Now if I input these 10 crores in business one, how much money will I get in return? Similar for business two, business three, and business four. So this is what comes in return on capital employed. Okay. Now, if you remember in the last slides, we have discussed the operating profit margin. That is different. The physical significance for that was that the amount of money or the amount of margin that you can have when you do a sales. How much operating profit margin you have when you sell a car, or when you basically sell any other product that you have created, how much operating profit margin you have. While ROCE tells you the total money that you put in the business, how much is the return on that. Okay, so both have different physical significance and it's important to understand. Now let's take an example of same Tata Chemicals and analyze it with the peers. So if you can see the Tata Chemical has our ROCE of 12.27. That would basically means if we are putting 100 rupees in Tata Chemicals business, we are able to generate 12 rupees, 12.27 rupees, okay, in a year. Whereas Pidilite is able to generate 24, and if you say Solar Industries, it has 36. Okay, that means they are able to generate more from the money which is put into the business. Again, the products can be different, but this is a very good method to compare it with the peers. And we generally also compare with the industrial median. So the industrial median is 18. So yes, Tata Chemical has a low return on capital employed. That could mean somewhere the amount of money that is put into the business, they are not getting the profit out. But that could also mean one more thing, that they are putting more money into the business because they are expanding. Suppose I'm buying a lot of new machinery this financial year, that means I will put a lot of capital in this financial year. So my ROCE will drop down. Yeah, again, it becomes important to compare the historical ROCE too. Okay, so this is all about return on capital employed. Now, next financial ratio which we are going to cover is your CAGR. C means compound, A means annual, G is growth, and R is your rate, compound annual growth rate. Now this will be a very exciting ratio for everyone because this will basically tell you how much money is your stock making. If you remember in lecture 5 financial ratio part 1, we talked about EPS, earning per share, whose physical significance was how much your share is earning, how much each of your share is earning. While your CAGR will tell you, because there is two factors in that, right? One is because of your sales, your share would be able to earn some amount, like 100 rupees share will earn 7 rupees, 8 rupees, 10 rupees, whatever that is based on the companies. But the second thing is that 100 rupees share will not remain at 100 rupees. That might go to 110, 120, 200, 300, whatever is the price. So that is also a return which you are getting, right? So that comes here. Now CAGR would be calculated as your final value by your initial value, say final value of today's date, and initial value is when you invested it. Okay, divided by 1 by time period. You can put them in year, like you invested for last 2 years, how much is your annual return. Now this gives your annual return, not the total return, which basically means annually this is how much percentage you are getting. And you can actually compare this percentage with your, say, a bank FD. A bank FD is giving me 7%. And my compound annual growth rate for my investment in this stock is 10%. So I am getting a better return annually. Okay. Now let's take an example and try to compare Tata Chemicals with the peers on CAGR. Okay. So in 1 year, Tata Chemicals has given a return of 21%, while Pidilite has given around 22%. And overall, the chemical sector has given me a return of 17%. That's not bad, right? I mean, the bank FDs were just giving me 7%, while the chemical sector gave me like 17% of an annual return. Okay. While for 5 years, again, you can look like it's 20% for Pidilite, for Deepak Nitrite, it's 55%, for Tata Chemicals, it's 25%. I mean, it's pretty good. Over a 5 year, this is the amount of return which I'm getting. Again, it becomes important. How you are analyzing it is final value, which is your, suppose I'm analyzing today. So today's stock price divided by the stock price of a previous year at the same date, that would be your 1 year. Or if you divide it by 5 years back on the same date, that would be your CAGR for 5 years. Okay, so you can easily calculate it. But wait, this is not just your total return, right? You might be getting dividends also. Now you might be a bit confused. I mean, in the EPS, we learned that dividend is already accounted for. So why not just take EPS plus your CAGR and tell that this is my overall return? A bit confused? Let's go to the next slide and let's understand this better. So let's try to understand what is my net return. Suppose I invest 100 rupees and that becomes 200. So my net return is 100%, right? But in a stock, there are various terms, like first is your earning per share, which is the amount your share is earning because of the value that the share had. Because of the sales which the company is doing, your each share is earning something, which is your earning per share. And you can go to lecture 5 financial ratio part 1 to understand, to just revise it how we have done it. Now the net return would be your earning per share divided by market price into 100 will give you EPS percentage or the return from your share plus your CAGR, which is basically your return from the share price increase. Now share price increase based on the market. Okay, it could decrease, it could increase, and EPS works on your company's fundamentals. How good is your profit? If you remember, EPS was your net profit minus preferred dividends divided by your total number of outstanding shares, right? So EPS is what your company is fundamentally giving you, while CAGR is what the market is pricing your share price currently. Okay, but do you get the EPS? I mean, if I talk about, okay, that EPS, that earning per share, if I hold 10 shares and my EPS is 10 rupees per share, so that 100 rupees is mine, right? But it depends on the company whether they give it fully to you or not. Okay, now there are 3 ways the company can put their net profit which they gain from, say, this financial year. The first is they will declare dividend. Okay, they can declare dividend and give that money to the shareholders. Now they can give all the money or they can give a part of money. Okay, the second is they can buy back the shares. Suppose I make some profit, I have some net profit, I will go and buy back my company's share. What it will do, it will create a scarcity in the market of the number of shares and the overall price of the shares will increase. So that is like an indirect benefit to the shareholders. The third thing is the company will reinvest the amount in its business so that it can grow more faster. And as a common shareholder, you don't have the right to say what happens to the net profit. It depends on the company's managerial team. Okay, or the company can do all three with the net profit which is remaining. So then accounting for EPS directly in the net return wouldn't be good, right? I mean, overall, as a intangible, as a non-touchable profit, you have your EPS accounted, but you can't really get it, right? So what you get it is dividend. So a correct way to account for net tangible returns here, I would say, if you account for EPS, it could be net tangible plus non-tangible returns. Okay, so net tangible returns would be your dividend which you are getting. You can divide it by the current market price. This will give you the percentage of return plus your CAGR percentage over that particular year. So suppose I have 100 rupees stock which becomes 200 rupees, and the dividend that I got was 10 rupees. So 10 by 200 would give me a 5% return, and my 200 share price which was initially at 100 will give me a 100 CAGR. So my total net tangible return would be 105%. So this is how you are going to calculate your net returns. Okay. So let's proceed to our hands-on session, and the session would be focusing basically on learning how to use those ratios which we have learned, how to basically see them and do the peer comparison is the first point. The second point would be how to compare them over historically, how they were evolving over the year. Okay, so for the peer comparison, we will be using screener.in, and for the historical review, we would be using money control. So let's start with peer comparison on screener.in, and let's go to Tata Chemicals. Scroll down and you will see the peer comparison table. Let's go to edit column. So the first ratio we learned was gross profit margin. Let's go to GPM, and you will see the GPM for last quarter. So we are not able to see the GPM for last year in this site, but we don't worry, we have this in another site. So let's put GPM for last quarter for now. The second is operating profit margin, OPM. So let's take OPM for last year. Let's put it to the second place. Third, let's find out the net profit margin, NPM. This is our NPM for last year, so it's already here. I'll just put it here. The fourth ratio which we learned was your ROCE, okay, return on capital employed. So let's just put it here and drag it here. And the last ratio which we learned was CAGR. Now the CAGR wouldn't appear directly here. You have to type your returns. And on the right side, historical, you can see you have returns for 1 year and 5 year, which I already have here. So this is for return 1 year and 5 year. Let's just remove all the other ratios to avoid confusion. By the way, these are the ratios from the previous lectures, and you can literally combine all of them together in a single table. So let's remove them for now. Yeah, so this is how it looks like. So you can see for your Tata Chemicals, you can actually compare across the peers, like how is your operating margin doing on. By the way, you might notice that the data which we have seen in the table just during the lecture and the data here might be different. The reason being the data previously taken was from say 20th May when the slides were created, and this is the data today at the recording date of 26th June. So the data will be different, so you don't have to worry about that. So you can see the operating profit margin for Tata Chemicals is 63%, while the median is only 37%. And you can see across the peers, it has the highest operating profit margin. Gross profit margin. Now, what happens when we go to the operating profit margin? From 63%, it drops to 22%. That's the level of operating cost involved. And if you see across peers, still it's like second highest, third highest, or my fourth highest. Yeah, it's not that bad. But if you compare with the industrial median, it's still pretty good. It's almost twice. Let's go to the net profit margin. Now you will see the difference from gross profit margin to net profit margin. I mean, it almost reduced by 49 or 50%. Okay. Again, it is still greater than your industrial median, and across the industries, it's still comparable. I mean, it's not very less. Okay. Now let's go to ROCE, return on capital employed. Now the return on capital employed for Tata Chemical is less than industrial median, which is not a good sign, which basically means Tata Chemical is not able to generate enough returns than the amount of money they have put in the business. Now wait, you can't just really say that, because you are right now seeing ROCE for the current year. It is possible, like we discussed, that Tata Chemical has invested a large amount of capital in some machinery or in some equipment, and they might get better returns in the upcoming years. So that's why for making this statement more sound, we are going to analyze the previous year's data. And if the previous year's data are also bad, that would mean that their overall ROCE is bad. Okay. This is your CAGR for 1 year, and this is your CAGR for 5 year. Now, if you see, the CAGR for 1 year is 21%, which is kind of good across peers. And for 5 years, it is around 25%. You do have peers who have better CAGR for 5 years than Tata Chemicals. But overall, the industrial median is 17% for 1 year, and Tata Chemicals is ahead of that. So this is how you are going to basically analyze all these ratios and compare it with your peers and the second your industrial median. So for the second part of comparing these ratios with their historical data, let's go to moneycontrol.com, and on the top, let's type here Tata Chemicals. You will land at this page, and let's just scroll down, and you will reach to a heading called financials. Okay. In this heading, make sure you are on the consolidated part and you're looking at the annual results. Let's go to the ratios and let's click on the margin ratio. So you can see you will get all these ratios which we have discussed right now, and you can see how are they increasing or decreasing over the years. Now the action point here which you have to take is that over the years the margin ratios should increase, or if it's staying same, it's a good sign. But if they are decreasing, that's a bad sign. Okay, so you can just scroll your eyes from right to left and you can see whether they are increasing or not. In case of Tata Chemicals, they are increasing. Not a very high percentage, but still it's a good sign. Okay, now let's go to the return ratios, and you will find here ROCE. Just focus on the ROCE and don't worry about other ratio. So you can see the ROCE has actually improved from March 2019 to 2023. Okay, now you might be wondering that your ROCE was somewhere around 12% when we looked at a screener, and here it is just 10%. And why is it different? So the reason being, there could be two reasons. One is the way they are accounted or they are calculated might differ from one website to another website. And the other reason could be, see here you are looking at March 2023, but in screener.in, the heading says only ROCE percentage. They might be looking at a more recent data or maybe a quarterly recent data, which they have not really mentioned there. So, but you don't really have to worry. There you were able to compare with their peers with the same baseline. Whatever data they have used for the recent quarter or for the recent year or whatever, they have used similar method for comparing with the peers, for calculating the peers. So your comparison still is solid, valid. And here you are able to get for the annual results from 2019 to 2023. So you are able to infer that ROCE is increasing. That means company is able to get better returns on the capital employed, and which is a good sign. Similarly, over the top, you can see different categories of ratios. Now, if I go to per share ratio, you will basically have your EPS. Now, don't worry about the basic and diluted. We'll be covering it later. But yeah, you have your EPS over the years, how it is varying. You have your dividends per share value. You have your book values, how it is varying. And if you go to these liquidity ratios, you will have your current and quick ratio over the year. So with the current ratio, you can actually understand that over the year whether the company is increasing its debt or not. Same for the quick ratio, and you have even your leverage ratios here. I mean, by looking at the historical data, you can actually understand that how is the company strategizing over the years. Okay, so this becomes important. And this is your second point, right? And the first point was to compare it with its peers. How are the peers doing? So we have compared these 2 points also in this lecture. So feel free to explore this site more. Feel free to go over all the ratios, and don't worry, we'll be covering most of them, which is the part of our strategic sheet, which we will be starting filling slowly very soon. Okay, so that's all for the hands-on session. So that's all for lecture 7, fundamental analysis of companies. We hope you have learned something today, and you might have the feeling empowered by knowing the power of mathematics, just simple ratios, and you can get so much of how the companies is doing, how the peers is doing, how overall the industry is doing. And by now you might be starting comparing your company in which you are planning to invest or you're planning to analyze, how good is it as compared to its peers, how good is it doing from last 5 to 10 years. And it's really amazing to know all these things just by looking on simple tables with the simple ratios. But the reason we went into so much depth is to understand what is the physical significance of these ratios. So 2 things to take away: understand the physical significance, make sure you understand what they actually mean. And the second thing is that you know what is your action point. After understanding the ratio's physical significance, you know what you have to do next would be your second important point to remember and take an action on. So see you in the next class.